The evolution of modern finance, from primitive barter exchanges to intricate systems of bills, credit, banking, and global capital markets, is one of the most remarkable transformations in human history. A slow but profound journey that reshaped how societies create value, manage risk, store wealth, and enable cooperation across vast distances and generations. At its core, finance is simply the infrastructure of trust, a set of tools and agreements that allow people to exchange today what they believe will be valuable tomorrow. But tracing its evolution reveals far more than technical innovation. It unveils a story of human ingenuity, ambition, conflict, and adaptation, stretching from prehistoric trade routes to medieval merchant guilds, Renaissance banking houses, Enlightenment-era stock exchanges, and the fully interconnected financial systems that govern today's global economy. To understand how finance evolved, one must begin with the earliest form of exchange barter. In small communities with simple needs, barter worked well enough. One farmer exchanged grain for another's livestock, or a potter traded her wares for cloth. But barter had severe limitations. It required a double coincidence of wants, meaning both parties had to want what the other offered at the same moment. It made savings difficult, as goods decayed. It strained trust, because there was no standard of value. Barter's inefficiencies eventually forced societies to create a universal medium of exchange, leading to one of humanity's greatest innovations, money. Early money emerged in many forms: grain, cattle, shells, feathers, salt, beads. But over time, precious metals became dominant. Gold and silver possessed durability, divisibility, and universal appeal. Ancient kingdoms minted coins to standardize value, stamping them with the symbols of rulers to ensure trust. Coins spread along trade routes from Mesopotamia to Egypt, Greece, Rome, India, and China, enabling commerce across continents. Yet as trade networks grew, carrying large amounts of metal became dangerous and inefficient. Merchants needed a safer, more flexible method to store and transfer wealth. This necessity pushed finance into its next evolutionary stage, the rise of early banking. In ancient temples from Babylon to Athens, priests safeguarded deposits and recorded loans on clay tablets. Roman bankers, or argentarii, facilitated credit, currency exchange, and complex commercial transactions. Meanwhile, in China, the demand for portable money led to the invention of paper currency during the Tang and Song dynasties, centuries before Europe would adopt the idea. But the most pivotal innovations emerged later in medieval Europe, where commerce expanded rapidly. Italian city-states such as Florence, Venice, and Genoa became the crucibles of modern finance. Families like the Medici developed double-entry bookkeeping, allowing merchants to track profits and losses accurately. They also pioneered bills of exchange documents that allowed traders to move money from one city to another without physically transporting gold. A Florentine merchant could deposit funds at a banking house, receive a bill, and redeem it in London or Bruges. This transformed finance from a system bound by geography into one capable of spanning continents. Bills of exchange were revolutionary because they made trust portable. A slip of paper could move through multiple hands, settle debts, and facilitate large-scale commerce without direct oversight of rulers or armies. This early form of financial globalization enabled merchants to finance long-distance trade, manage risk, and diversify investments. The medieval fairs of Champagne became hubs where bankers, traders, and governments converged to negotiate credit, exchange currencies, and fund ventures. As Europe moved into the Renaissance and early modern periods, finance grew more sophisticated. Joint stock companies emerged, allowing multiple investors to pool money into risky expeditions. The Dutch East India Company became the first major corporation whose shares could be publicly traded, and Amsterdam established the first modern stock exchange. These innovations spread to London, Paris, and beyond, laying the groundwork for equity markets. The expansion of global trade, driven by exploration, colonization, and new technologies, required vast amounts of capital. Companies issued shares, governments issued bonds, and banks provided the credit infrastructure necessary for imperial expansion. Finance and geopolitics became deeply intertwined. Wars were funded by loans, colonial projects depended on capital, and financial crises could topple governments. But while stock markets and international banking expanded, another breakthrough fundamentally transformed finance: the central bank. Sweden established the first one in the 17th century, but it was the Bank of England, founded in 1694, that became the model for modern central banking. It issued notes backed by the state, stabilized currency, and managed public debt. Central banks gradually evolved into the anchor institutions of national economies, providing liquidity, regulating currency, and intervening during crises. The Industrial Revolution accelerated the evolution of finance yet again. Factories, railroads, mines, and steelworks required enormous investment. Private wealth was no longer enough. Stock markets became engines of industrialization. Bonds financed infrastructure that spanned continents. Insurance companies managed risk for ships, cargo, buildings, and entire industries. Banks grew larger and more sophisticated. Finance became the backbone of modern capitalism. But with growth came volatility. Speculative bubbles erupted: the South Sea bubble, the Mississippi scheme, railroad manias, and many others. Each crisis revealed weaknesses in financial systems and spurred new regulations. The 19th century saw the expansion of central banking, the spread of limited liability laws, and the creation of professional banking houses such as the Rothschilds, Barings, and Morgans. These institutions acted as stabilizers during periods of turmoil, shaping national policies and global capital flows. By the 20th century, finance reached a new level of complexity. The gold standard linked currencies to a fixed value, enabling stable international trade. Yet World War I shattered this system, and the interwar period brought extreme volatility, culminating in the Great Depression. Governments responded with sweeping reforms: deposit insurance, securities regulation, and monetary policies that gave central banks greater control. After World War II, the Bretton Woods system established the IMF, World Bank, and US dollar as the anchors of global finance. This framework stabilized currencies, facilitated reconstruction, and laid the foundation for modern globalization. As the second half of the 20th century unfolded, finance penetrated every aspect of economic life. Credit cards democratized borrowing, mortgage markets fueled home ownership. Pension funds invested in stocks, linking millions of workers to corporate performance. Derivatives markets allowed sophisticated risk management. Digital technology created electronic exchanges, high-frequency trading, and instant global transfers. The world entered an era where finance was no longer just a support system. It became a driving force of economic strategy, geopolitical leverage, and societal structure. Yet finance remains a double-edged sword. It enables growth, innovation, and stability, but it also magnifies instability when misaligned incentives or excessive speculation take hold. The crises of 1987, 1997, 2000, and especially 2008 showed how interconnected and fragile global finance had become. Each crisis sparked reforms, but the fundamental trend remained. Finance has grown increasingly complex, increasingly global, and increasingly central to everyday life. Today, digital currencies, decentralized finance, mobile payments, and algorithmic trading represent the newest chapter in this long story. From barter to bills, from paper notes to digital tokens, from village markets to global exchanges, finance continues evolving as humans find new ways to trade, invest, speculate, and collaborate. And through this evolution, we see not only the development of economic tools, but the unfolding story of human progress, driven by trust, imagination, and the constant pursuit of a better system through which people can exchange value, manage uncertainty, and expand the realm of what is possible, all building toward a world in which finance functions as both the engine and the architecture of modern economic life, shaping not just transactions, but the behavior of nations, corporations, and individuals, in ways that would have been unimaginable to the early traders who once bartered livestock for grain. In the second phase of this story, after mapping the long arc from barter to early financial instruments, the narrative shifts toward the deeper implications of modern finance, how each innovation altered human society, how financial systems became the backbone of civilization, and how the very logic of value transformed as money evolved from physical goods into abstract promises and finally into digital signals moving at the speed of light. Modern finance is not merely a collection of tools. It is a worldview, a system of coordination, and a quiet but pervasive force that shapes how people dream, plan, build, and interact. The first major transformation that modern finance imposed on society was the separation of value from physical substance. In the ancient world, money had weight: gold, silver, copper. Its value came from scarcity and physical form. But as bills of exchange, paper notes, and later central bank money took hold, value became symbolic. A note was trusted not because it was precious, but because the issuing authority maintained credibility. This shift was revolutionary. It meant that wealth could be created not only by mining or conquering, but by organizing trust. It meant governments could finance wars and infrastructure without hoarding metals. It meant commerce could flow smoothly even when goods were far from their buyers. This abstraction of value laid the foundation for modern economic expansion. The second transformation was the democratization of credit. In earlier eras, borrowing was a privilege reserved for merchants, nobles, or states. But modern finance through banks, credit markets, and later consumer finance allowed ordinary people to access capital. Mortgages turned tenants into homeowners. Business loans turned craftsmen into entrepreneurs. Student loans expanded education. Credit cards revolutionized consumption. The ability to borrow against the future fundamentally changed social mobility, enabling individuals to invest in themselves in ways previous generations never could. Yet it also introduced new risks: indebtedness, inequality, and vulnerability to economic downturns. The third transformation was the rise of large-scale capital markets. Stock and bond markets became mechanisms for pooling the savings of millions and channeling them into industries that reshaped the world: railroads, automotive plants, telecommunication systems, aerospace innovations, and eventually digital technology. Modern finance made it possible for entire societies to invest collectively in the future. Pension funds, mutual funds, and insurance companies became long-term stewards of national wealth. Through them, the average worker became a silent shareholder in corporations that spanned continents. Finance thus linked the fates of individuals to the performance of enterprises they would never meet, illustrating the deep interdependence of modern capitalism. The fourth transformation involved the globalization of financial systems. As communication technologies advanced, from telegraphs to satellites to the internet, finance became borderless. A bank in London could lend to a company in Shanghai. A pension fund in Canada could buy bonds issued in Brazil. A currency crisis in Thailand could shake markets in New York within minutes. This global integration accelerated development but also amplified volatility, creating a world where no economy stood entirely alone. International institutions such as the IMF and World Bank emerged to manage global interdependence, offering stabilization, development funding, and crisis intervention. The fifth transformation was the rise of financial engineering. Derivatives, futures, options, swaps, securitization tools, originally designed to manage risk, expanded into a vast ecosystem that reshaped global markets. These instruments allowed companies to hedge currency risks, farmers to lock in harvest prices, and investors to diversify portfolios. But they also introduced complexity that few understood, contributing to crises when misused or misunderstood. The 2008 financial collapse, driven by excessive leverage and opaque securities, revealed both the power and danger of financial innovation. It showed that finance could lift societies, but it could also destabilize them when incentives became misaligned. The sixth transformation was digitalization. Computers replaced ledgers. Electronic markets replaced trading pits. Payment apps replaced cash. Cryptocurrencies introduced entirely new forms of decentralized value. Trading algorithms executed thousands of orders per second. artificial intelligence began analyzing risk, predicting market movements, and optimizing portfolios. Finance became faster, more interconnected, and more abstract than ever. Money ceased to be a physical object and became pure information numbers, stored in servers, signals transmitted across fiber optic cables, decisions executed by code. This digital shift redefined privacy, security, and financial sovereignty, raising new questions about who controls money and how it should operate in a world where geography matters less than bandwidth. Yet beneath these transformations lies a deeper truth. Finance, at its core, has always been a social technology. It works only because people believe in it. Trust underlies every contract, every payment, every bond, every digital transaction. Modern finance expands trust through institutions, central banks, courts, regulators, auditors, rating agencies, but also challenges it during crises. The collapse of a major bank can undermine confidence across nations. Inflation can erode the meaning of savings. Mismanagement can spark political upheaval. Finance is powerful precisely because it touches everything: livelihoods, national stability, global trade, social welfare, and even cultural identity. Another profound implication of modern finance is the tension between efficiency and stability. Markets excel at allocating capital quickly and dynamically, but they can also overreact, overshoot, or fail spectacularly. Governments strive to balance freedom with oversight, innovation with safeguards. This balance is delicate and constantly shifting. Too little regulation invites bubbles and fraud. Too much stifles entrepreneurship. Every era, from the panic of 1873 to the crash of 1929 to the dot-com bust, has forced societies to recalibrate where that balance should lie. Despite these challenges, finance remains one of humanity's most extraordinary achievements. It allows people to pool risks, mobilize collective effort, and build structures physical, social, and digital that no individual could accomplish alone. Modern cities, energy grids, hospitals, universities, and transportation networks exist because finance made them possible. So do scientific breakthroughs, from vaccines to space exploration. Behind every technological leap stands a financial system that took a chance on uncertainty. And as we look toward the future, the evolution of finance is far from complete. Digital currencies may redefine sovereignty. Decentralized finance may challenge traditional banking. Climate finance may reshape global investment priorities. AI-driven markets may accelerate both opportunity and instability. Yet whatever form finance takes next, it will continue to reflect the same fundamental forces that shaped it since the age of barter: trust, innovation, cooperation, and humanity's relentless drive to create systems that extend our capabilities beyond the limits of the present. In the end, the journey from barter to bills to digital finance reveals not just how economies evolved, but how humans learned to imagine futures and to fund them. It is a story of problem-solving, risk-taking, and collective belief. A story that shows how we transformed simple trade into the complex financial architecture that underpins modern civilization, shaping the possibilities of societies and the destinies of nations. Completed.